The words investor and trader are commonly thrown around in the financial world as if they're the same thing. People will replace one for the other, but that couldn't be more wrong. While common to flip and flop, the two classifications are fundamentally different. And if you don't understand that, that's probably going to hurt you as a trader or an investor. You'll likely end up like the vast majority of people who enter financial markets and lose money, myself included, for a long period of time. But it really wasn't until I saw, and I was on the dark side for many years, but that I saw the light and I experienced the light, and I am experiencing the light as we speak, that it clicked. The difference between trading and investing couldn't be more clear, but it's not for the majority of people who get into trading or investing. So it wasn't until seeing the light, seeing consistency, that I was able to look back and say, what was I doing when I was losing versus what am I doing now? How do I approach things? How do I view things? And this trading and investing concept kept coming up because we intertwine the two terms and we also intertwine the two concepts. It's very, very common, and I get why, but if you think that way, you're fundamentally not going to be successful in either of the two fields. You have this shift in mindset if you want to be successful in either of the two. And Mark Douglas, those who know Mark Douglas, the trading psychology guru, he was right when he said the consistency you seek is in your mind, not in the markets. That's 100% true. You have to understand and be able to compartmentalize trading versus investing. I would recommend you don't, because most people can't, but you're going to do it anyway. So let's at least explain what you need to do and how you need to think to be more successful at both. So let me clarify this. Technically speaking, yes, you can do both. It's going to be very difficult to do so, and it will probably take a lot of time, but trading is not investing. Investing is not trading. Get that in your freaking head. They are not the same. They are not the same. Why? The fundamental base to trading is not the same as investing. You cannot be a trader and say things like, dude, let's just buy the dip. Oh, I'm going to DCA for life. You can't do that. You can't dollar cost average. You can't buy the dip unless that's part of your plan on that specific trade of that asset. If you do so, you'll end up having a trade at some point, many times sooner rather than later, that blows your back out. And when I mean that, you are going to blow an account, okay? You're not going to literally blow your back out. I mean, some may, but you're going to blow an account. You're going to blow an account and you're going to have no money left, and that's it. Because you can't just assume everything's going to go up or down or whatever you do, shorting or longing. The markets change, you have to change with it or adapt, or just respect some sort of risk management approach and try again on the next one. It's not that complicated. Doesn't mean that it's easy though. Investors can be boiled down really into two kind of camps. First camp is the dollar cost average for life. The second camp is the do research fundamental guys or gals who understand fundamental value. You know, you buy a company cheap and undervalued, and you ideally want to sell it when it's expensive and overvalued, right? You're going to lose some, probably a lot, but if you hit one or two, for example, if you hit NVIDIA like 10 years ago, you're like, let's fucking go, I'm set. You're happy, right? So that's kind of what it comes down to. Now, dollar cost averaging for life, you could just look at the S&P and say, hey, I'm going to buy the S&P every Friday, and every Friday I'm going to put in $100 or $1,000 or whatever based off your income, right? You're going to put in however much money you want to put in, and you're just going to continuously buy the S&P. You know the S&P returns like 8-ish%, whatever the number is, across history. You know, hey, despite like there'll be bull markets, there'll be bear markets, there'll be recessions, there'll be collapses, there'll be this and that. But if I just keep doing this for the rest of my life, God willing that I have a job and can do so, have income coming in to do so, if I do that, I will probably have a lot more money in 20, 30, 40, 50 years than if I didn't do that. Okay. So like that's the two kind of camps, and you can do that for stocks and you can do that for ETFs and you can do it for whatever you want. Kind of. I personally say that it's better for like just ETFs like the S&P or I guess the index. Like if you want to go to the S&P, the Dow, the Russell, you want to go to the NASDAQ, like dude, you can do it there when you have that massive history. You can't really do that for individual stocks. I guess you could in theory, but you want to diversify that because there's a lot more risk you're taking on when you go one stock at a time, or when you start buying individual stocks versus buying an ETF or buying a broad index. The biggest problem today that we have is that a lot of us get introduced to the financial markets through investors or through things like CNBC, where it's kind of like investing focused first and not trading focused. Like, it's not actually trading focused. People will talk about trades. I'm going to make a trade here. I'm going to do this. I'm going to do that. But when they refer to that, that could just be like, I'm buying in or I'm selling here, or it may not actually be like a true trader's perspective. That's the problem. Because the two terms are mixed, intertwined so much, when you get into it, and I think that that's the problem that at least my generation had, when these big finance YouTube guys, and social media guys came on the scene, they bring in large audiences, but then those audiences start to meander into their own interests. And then they say, you know what, why am I going to just do what this guy does? I'm going to go over here and I'm going to see if I can start trading, because I can make more money than he gets or than he returns every single year. And so when you come at it from that approach, you now have a fundamental investing background, like the buy the dip, the dollar cost average. You want to buy when people don't want to buy, you want to buy when there's fear, etc. Right? You take that fundamental approach and you bring it over to investing. Now you're up on a position, it starts to go against you. Let me double down. Like, those things are absolutely congruent with consistently losing traders. Consistently losing traders have this investing background approach and they can't shake it. When you can finally shake it and you can say, hey, I am trading, I am over here, I am not investing over here. My investments are simple. They take me 10 minutes a month, right? I just dollar cost average. I don't have to worry. That's 10 minutes a month. I do that on a Saturday. The first Saturday every month, I worry about that and I look at it and that's it. The rest of my time, I spend trading. So I am developing a trading plan, a strategy. I'm tracking my data. I'm tracking positions. I am respecting risk. I'm putting stops on. I'm taking profits at my targets. I'm understanding my numbers, I know where I'm at, and I'm making adjustments accordingly if I'm not making money over a couple of trades, 10, 20, 30, 40, 50 trades. As the sample size gets bigger, the more valuable that your data is, and the clearer it will become if you actually have something or if you don't. That's my rant. Hope it was helpful. You can technically do both. Very hard to do so. Highly recommend you focus on one at a time over large periods of time until you get good at it, and then you can move into the other after you have a core fundamental base with your investing or trading strategy. Then you could swap over to the other and see what you can do there. Thanks so much, guys. Any links, resources are down below. I'll see you in the next one. Peace.